What is the impact of contango and backwardation on commodity funds? Imagine you're watching the prices of commodities like oil or gold shift day by day. Sometimes the future prices are higher than today's spot price, and other times they are lower. These changes can really influence how your commodity investments perform. Contango happens when futures prices are above the current spot price. This often occurs because storing commodities costs money, like paying for warehouses or insurance. For example, oil and natural gas often show contango because they need large storage facilities and have high holding costs. When a fund invests in futures contracts during contango, it might face what's called roll costs. That means when it sells an expiring futures contract and buys a new one at a higher price, it loses money. Over time, these costs can eat into the fund's returns. Some funds try to avoid this by holding physical commodities instead of futures or by using strategies to reduce roll costs. Backwardation is the opposite. It happens when futures prices are below the current spot price. This usually occurs when there are supply disruptions or high demand for immediate delivery. For example, if there's a sudden shortage of gold or oil, the spot price can be higher than future prices. Funds in backwardation can actually benefit because they can sell the physical commodity at a higher spot price and buy futures at a lower price. This can lead to better returns, but it requires careful timing and market analysis. If the market shifts unexpectedly, these gains can disappear. When evaluating commodity funds, understanding how contango and backwardation affect performance is key. Funds that invest in futures need to manage roll costs carefully during contango to avoid losing money. Conversely, funds that can capitalize on backwardation might see higher returns, but only if they can predict market moves accurately. Many managed funds use specific strategies to navigate these conditions, aiming to protect investors from the negative effects of contango and to take advantage of backwardation when possible. Knowing these market conditions helps you decide if a commodity fund aligns with your investment goals. It's worth checking how a fund manages these situations, as they can significantly influence your overall returns.